Hi guys, so let's now take a look at our second lesson on different financial institutions. Okay, so firstly we've got the National Savings and Investment Organisation. Now this is a government-backed organisation which is responsible for offering independent savings accounts, premium bonds and bonds or gilts as they also can be known as. Bonds and gilts are just high quality, low risk bonds of course. Now this helps to fund government activities, and of course in the UK we have a large amount of UK government debt, £1.7 trillion worth, and so part of that money is actually funded by people investing with the NS&I. Okay, the downside of this is that you're likely to get a poor, or in the case of premium bonds, no interest rate in terms of your actual return. So interest rates of course are very low at the best of times, but premium bonds of course have no interest on them. Okay, and there may also be issues regarding the accessibility of actually having government bonds and being able to sell them to actually turn into cash, likewise with those ISAs as well, and so it often means that you need to provide notice for withdrawal of any money that you're taking out. Okay, moving on, insurance companies then. So these are businesses that of course protect against the risk of loss. Because they're businesses, of course they focus on profit making. Okay, so they want to make profits, so that means that they're likely to be quite innovative in terms of the products and services that they offer. They may focus on providing good quality customer care, or some of them might focus on low cost and poorer quality customer service perhaps. Okay, but anyhow you're likely to see a range of services and cover being available. Now the premiums that they usually charge are likely to reflect the degree of risk that is apparent within whatever scenario that you're looking at, whether it's teenage drivers or whether it's people with various health conditions and life insurance or life assurance. Okay, now of course those premiums will be set in line to ensure that the business makes a profit overall. Okay, so moving down here, let's have a look now at pension companies. So pension companies meanwhile sell policies to fund people's retirement. So you pay into a pension policy through your working life, and that of course means that you will have money redispersed to you when you retire. They will be sold to individuals or to employers who then provide them on behalf of their employees, and money will be invested by the pension company, and they will employ investment experts here to ensure to help ensure that the money is likely to actually gain in value and that your actual retirement fund will grow in value. Okay, however, there is of course a risk of loss, or alternatively just a poor return in actually paying into these pension policies. So if those investments do not feature well, then yes, your pension funds may actually perform poorly. Okay, further to this, money is also locked in to the policy agreement that you actually sign up to. So whether that's retiring at 65, 70 or so on, okay, that will be stipulated in your agreement. Okay, now we've got pawnbrokers. Okay, so pawnbrokers, businesses that lend money against a security. Okay, so common example used is jewellery, watches, those sort of precious items which are relatively small and can be easily transported, carried, stored in a safe and so on. Now, here, items are likely to be bought back or may be resold. Okay, so imagine a scenario where perhaps you have a very nice Rolex but you need some cash. So you might go to a pawnbroker and ask them for money against that Rolex that you have then just given them. Okay, so you ask for £1,000 and they in return have your Rolex until you pay them back that money. Now, once you pay them back that £1,000 plus the interest, then you'll be able to get that Rolex back, okay? But with certain items, of course, it may be that you don't manage to actually repay that debt, and therefore the pawnbroker may then resell that item. Now, alternatively, the other way that you can use pawnbrokers is to actually take that same Rolex in there and say, how much would you give me for this particular product, okay? But they will tend to offer you a rate which is quite far below market value, so do bear that in mind, all right? So you're not necessarily going to get a fair market price, particularly if you're looking quite desperate for money and so on, okay? So there's likely to be a short-term cost involved in this, and there's the potential for a long-term loss if you don't manage to actually pay that money back, and you might lose an item which has sentimental value. Okay. There's also low values offered on products purchased, as we mentioned there. So let's finish up now with Payday Lenders. Now, Payday Lenders have been in the news a lot in recent years. Payday Lenders, their responsibility really is to provide short-term immediate cash to help people between paydays, okay? So that's the way in which Payday Lenders operate. Now, it means that they will charge for that service. In addition to that, they will charge a rate of interest, which of course is very, very high. But you can only borrow money up to about 30-day periods or so. So that means that while the interest is very high, and if you look at the APR on various payday lender sites, you'll find that it's often sort of 1500% or so, not as high as 2000%, but okay, so it does mean the APR is very, very high, but of course you cannot borrow for a whole year as a period, okay? So it means that you can get the cash very, very quickly. Some of them actually pride themselves on being able to give you cash in your bank up to about £400 in your bank in 30 minutes, okay? So it does offer a very, very quick short-term source of finance, but it's very expensive, of course. Okay, so there we go, guys. That's financial institutions wrapped up there. I hope you enjoyed that. Thanks a lot. See you next time.